Okay, Chapter 6, Closing Entry. So we're getting down to basically the last couple steps in the accounting cycle. So in Chapter 6, we're going to show you the basic entries on how you close out what is called the temporary accounts, post them to the ledger, and then do what is called a post-closing trial balance. Okay, and as you can see here, the steps in the accounting cycle, we basically have walked you all the way up to right here, which they say is step number 7, which is to journalize and post the closing entries. Now notice we've just completed, after chapter 5, we just did the adjusting entries. So now we're basically just going to clean up the ledger, get it reset for basically the next period. And so we'll do that in this chapter. We will also do a post-closing trial balance. And the interpretation of the financial stuff, we're going to be doing that basically all semester, but that's basically at some point in time you're going to sit back and look at your balance sheet and say, how much cash do you have? How much is your debt and so forth. So that's what they're talking about at that point, where you're basically, you got the financial statements and now you're just basically doing interpretations. Okay, so when we get into doing the actual closing entries, the textbook introduces a new account called the income summary account. And I want you to note that this is going to be called a temporary account. Write that right up here, a temporary account. And its sole purpose is to assist with the closing of your revenues and your expenses. Now, on a few of the PowerPoint slides coming up, I'm going to show you the textbook version of how they report or record closing entries. And I'm also going to give you an alternative way that's actually a little bit easier, I think a little bit quicker to actually do the closing. And I will show you that once we get to the slides. So again, like I said in the previous slide, the income summary account is called a temporary account, meaning that it's going to be closed out each period. Notice it does not have any sort of normal balance, because it's going to be basically the balance of this account depends on what your revenues or your expenses are, and so it could be either debit or credit. Okay, but the point is we're going to zero out this account at the end of the period. Now I'm going to jot some notes on here just to kind of give you some review here. So just remember the other types of temporary accounts. So we have, I'm going to draw this. We're going to say we have temporary versus the permanent accounts, because that's going to be a key in this whole chapter. And the way you remember the difference is, think of your permanent accounts as anything that is on the balance sheet. Okay, so your balance sheet accounts are considered your permanent accounts. So think of your assets, your liabilities, and your equity. Okay, now, so basically everything else then is considered temporary. So what's considered temporary? It's your income statement, accounts, plus the drawing account. Okay, and those are going to be the accounts we're going to be dealing with primarily in this chapter to actually do the closing. So remember, income statement is your revenues and your expenses. So if you want to think of this in terms of categories, your temporary accounts are literally your revenues, your expenses, and your drawing. Those are going to be the accounts that you zero out along with income summary in this chapter. Now, we're going to do 4 steps in this actual closing, and as you go through each steps, notice the first one says transfer the balance of the revenue account or accounts to income summary. That'll be step number 1. Step number 2 will be to transfer, it's the expense accounts to the income summary. That'll be step 2. And it's at that point that you're going to get a balance in income summary, whether it's a debit or a credit balance, and then you're going to transfer that or close that out to the actual capital account. That'll be step 3. And then step 4 says to transfer the balance of the drawing account to the capital account as well. So if you notice, everything is going to the capital account. And remember, the capital account, write this up here, is on the balance sheet. Okay, it is not a temporary account, it's a permanent account, and it's the only permanent account that's going to be used in any of these closing entries. But the point is we're not closing out the capital. I'm going to write this down at the bottom here. I want you to think of this as we're going to be updating the capital account, and that's basically what's going to happen once the closing entries have been posted, is your capital account will be updated. Everything transfers to the capital account. And the most common income account or revenue account we've been using so far is this account called fees income. And because it is a revenue account, it increases on the credit side. It's going to have a credit balance of $47,000. So think about it. If we want to close out this account to make it have a zero balance, we're going to have to debit the fees income account to make this account go to zero. So notice, again, using the T account idea, if we were to actually close out this fees income account, we would be debiting fees income for $47,000. That'd be the actual journal entry. And then you're going to credit income summary for the same $47,000. And notice, once you post this into your ledger, your fees income account will then be zero. Okay, so temporarily it's going to be held in this account called income summary. And here is a little more formal approach. Here's the the debit to fees income and the credit to income summary. Notice debit credit, and at this point in time, the fees income, once it's posted, the fees income would have a zero balance. Now the next step will be step 2, which will be to close the expenses, and we'll use the income summary as our account to transfer those into. And remember, expense accounts have what? Debit balances, and so in order to get these balances to go to zero, we're going to have to credit all of the expense accounts and then post them to the ledger. So in the example we're going to show you in a moment, once you add up, there's actually 5 expense accounts, and once you close those to zero, if you add them up, the total is going to be $13,333. That's going to be debited to the income summary account. And so notice, here's your ledger format. You've got salaries expense $8,000 debit, utilities expense $650 debit, supplies expense $500 debit, and so forth. So in black, you can see you've got all the balances. And when we start to close these out, notice the closing is going to go on the credit side of these expense accounts. So what will happen is once we've recorded the actual entry and then transferred it to the income summary account, you could basically say each of these accounts is now going to have a zero balance once they've been posted. And at that point, notice on the income summary account, the credit side represents your revenues and the debit side represents your expenses. And notice, rather than doing 5 separate journal entries, they just do one compound entry where they just put all the expense accounts and the credits. Notice crediting your salaries expense, utilities expense, and so forth. They put this in one entry and then one debit to income summary. And of course, this would be called a compound entry because you're using 3 or more accounts. Now, if you wanted to write these out individually 5 different times, that's fine. I'm not going to be too much concerned with that, but it's much more efficient to just put it into one entry. Okay, so at that point, once you've closed your revenues and expenses, notice at this time, so your revenues were on the credit side and your expenses were on the debit side. And if you get a balance at that point, you'd have $33,667. Note, that's like saying revenues minus your expenses. So this balance actually represents a net income. Now, because it is on the credit side, if we want to now close the income summary account and make that go to zero, guess what? We're going to have to debit it to get rid of that credit balance. And notice, once again, I'm just going to skip down to the bottom here. Once we do close that net income out, notice we're going to simply transfer it to the capital account, and therefore the capital account is actually going to increase by this amount because net income does increase equity. So notice, once again, we've got the income summary. It's going to go to zero, and then once we close that balance out, it's going to basically go over to the capital account. And now the capital account has an additional $33,667. Now notice the capital account had a starting balance of $100,000, and once you've transferred this over, this capital account is going to now have a balance of $133,667. The only other thing that could affect this would be the drawing account, which is going to be a drawn example. And then once we post that, then we can get an updated ending capital balance from the ledger. So once again, here's the formal journal entry to close out income summary. Notice debit income summary and simply credit capital. Okay, now the last one will be to close out the drawing account. And because the drawing account is going to have a debit balance, because that's the normal balance, in order to get it to go to zero, we're going to have to credit the capital account. But just go through the steps here. But instead of using the income summary account, we're just going to close this directly to capital. So notice we've got the debit balance. If we want this account to go to zero, we're going to have to credit it. And then by crediting it, we're going to be debiting the capital account. So notice the balance right there is after you had closed out the income summary. So now once you post this entry, the capital account is going to go down by another $5,000 to get the ending or updated capital balance. And here's the formal journal entry, debiting the capital and crediting the drawing. And that's the last step in the closing process. Now note, so if you go to the capital account in the ledger, notice you had $100,000. There's the net income transfer, there's the drawing transfer, and now the ending balance is $128,667. So I want you to think of this as the closing entries is the process by which you close out revenues and expenses in the drawing into the capital account. And quite literally, all this is summarized on your equity statement anyway. If you go back and review your equity statement, you'll see that you have typically a beginning balance, and the question says, what do you add to it? You're going to add net income, and then you subtract the drawing to get an ending balance. So basically, you've already kind of done this indirectly because you've already done an equity statement. Think of this chapter as this is just kind of like the process by which you get that capital account to be updated. And note, here is basically a summary of all your closing entries. And notice if I just kind of label these, you got the first one, there's your revenues. The second one is your income summary. And the third one is closing out income summary. And then the fourth one is closing out drawing. Now, I said earlier, there's another way to do this, and I'm just going to kind of tell you this just from, okay, you don't have to always use income summary. Now, yeah, income summary questions may come up in some of the quizzes and homeworks, but an alternate way to do this is to, do you see where you see income summary on the first one? So we got the first, closing entry to close out your fees income. An alternate way to do this is, rather than using income summary, you could just use capital. So you debit fees income, credit capital. And then on the second one, same thing, where you see where you see income summary, just substitute the account capital, okay? And then if you do that, you wouldn't even need that third entry because you would already have both the credit and the debit balances already transferred into the capital account, okay? So if you did it that way, look at the third one, you still debit capital, credit drawing. You could actually reduce your closing entries to only 3 steps. Now, it's not that really big of a deal. It's not going to matter on a test-wise either, but just kind of say there's an alternate way to do this. If you did not want to use the income summary account, you could literally just close everything into capital because ultimately that's what everything's going anyway. So I just wanted to show you there's an alternate way you could do this. If you did not want to use income summary, just substitute capital in there, and if that's the case, then you wouldn't even need the third entry. And the third step listed in the PowerPoint, and then overall you'd only actually need 3 closing entries. So if you want to just do it this way, that's fine. There's nothing wrong with that. That's really preference in my opinion, but I'm just going to show you a couple different alternative ways. This is the way your textbook does it, so you follow this for now, but if you have any questions, obviously email me or let me know. All right, and then the final step is once you posted everything, then you want to do a post-closing trial balance, which is basically all of your permanent accounts that have been updated on the balance sheet. And as you can see, we've already talked about this, but we're basically at the step here where we are doing that post-closing trial balance. And remember, the post-closing trial balance, post-closing means after you've closed. So the only accounts with any balances will be your balance sheet accounts, assets, liabilities, and of course your capital account. And so here it is. Here is your trial balance. And if you look at all the accounts listed, you've got cash, accounts receivable, supplies, prepaid rent, equipment, and so forth. But notice all these accounts are considered the permanent accounts. Okay, this is basically what's left on your balance sheet. Notice you don't see any revenues, there's no expenses, there's no drawing, because all of those have already been transferred into the capital account. But also notice at the end, your debits still equal your credits. So it's still a trial balance just like we did before, but this one is called a post-closing trial balance.